Credit risk is it's the risk of counterparty defaulting or partially paying its obligation. Credit risk is always one-sided, and the exposure can be further divided into two subcomponents. One is called current exposure, which is based on the current cash flows, and potential exposure, which is based on all future cash flows. There are other credit risk terms like LGD, loss given default, PD, probability of default recovery rate. They are all used in calculating the exposure, which is also called EAD, exposure at default. Credit VAR, CVAR. Like market risk VAR, uh, this is a credit VAR, and the the concept is still the same, but the terminology and the basic basis has changed. Market risk VAR, which is a left tail risk, companies worried about the losses which company has to bear due to change in market factors. Here, it's a right tail risk, the losses which company will bear in case the counterparty doesn't fulfill its obligation. So it's a right tail risk, because here we're not talking about the losses, but we're talking about the profits which turned into losses because uh, because the payments are never received, or partially they are paid out partially. So like VAR, it's a right tail risk measure because the credit risk is higher when expected incoming cash flows are highest. Example, a company CVAR over 1 month to be 10 million with a confidence interval of 95%. This would mean there is a 5% chance of a loss larger than 10 million in next 1 month. Difficulty interpreting credit VAR, because credit VAR is a right tail risk, whereas the market VAR is a left tail risk. We talked about it. It is the calculating credit VAR is also difficult because its constituents, or its I would say risk factors which are difficult to calculate, and like PD, recovery rate, and LGD. There's a lot of complexity involved, a lot of statistical modeling involved to compute these values. Exposure is difficult to calculate because there is a considering correlation, aggregation group, collateral agreements, netting agreements, into taking into account to come up with the correct exposure values. Only long positions has credit risk. Like in OTC product, credit risk is in forward contract. At settlement date, the counterparty entitled to receive payments faces current credit risk. When I'm saying current credit risk, I meant current exposure. The current credit risk as the payment is due immediately and counterparty could default. Credit risk in swaps. Swaps will have current credit risk on each payment exchange date and potential credit risk throughout its life. Interest rates and equity swaps has maximum credit risk in middle of the swap, because that will constitute the current credit risk plus all the future payment which will be received in swap, will be denoted by potential credit risk. Currency swap has a credit risk larger between middle to the end of the swaps, because the reason we have in the end for currency risk, because the notionals are exchanged only in the end of the swaps. Starting off, interest rate swaps has zero value to both the party, and also in the end, that's the reason the credit risk is minimal in the beginning or in the end. Credit risk is not isolated, exclusive to the swaps contract written between original counterparty. So if one counterparty defaults on some other loan and declare bankruptcy, the swap could also be impacted. So it's not necessary. It just happened between the counterparties. If your counterparty has exposure to some other party and that other party defaults, so and so that the immediate counterparty may not make payments. So that's what this fourth point is trying to explain. Credit risk in options. Only buyer faces the credit risk. Seller sells these options, he gets his money, he's out. There's no credit risk for sellers. Buyer redeem these options when these options have some value. So buyer faces the credit risk. They only exercise the option when the value is positive. After the option is purchased, the credit risk is the entire value of the option and is borne by the option buyer. Managing credit risk, there are various ways to manage it. Limit exposure, we just talked about in previous section. Mark to market, like periodically exposures are mark to market, they are netted. Collateral management, collateral is a way to reduce credit risk. Netting agreements, payments are netted between parties so that the credit risk can be minimized. Covenants, having a strict covenants in the legal contract reduce the credit risk, and use of credit derivatives like CDSs also helps reduce credit risk. Thank you.